And so in this series here, or this mini course, if you will, I'm going to be talking to you about what I will be doing in this bear market and what I have done to prepare. Now, is it time to get fearful and say, oh, the bear market is coming tomorrow? Absolutely not. But we do understand that there are bull markets out there, there are bear markets, and at some point we are going to see the bear and we need to be ready for it. But anyways, the first thing I would recommend doing is very simple, and that is to increase your cash reserve or your cash pile. And it's an option that a lot of people forget about, especially when they're looking at a roaring bull market, is they're putting as much money into the market as possible because they're seeing returns. But once you believe the market is becoming overvalued, or once you have good profits on the table, it might be a good idea to start increasing your cash pile. So any good portfolio out there has a certain percentage held in cash, and that could be for the purchase of if an opportunity comes up and there's a certain stock you want to purchase, it's good to have cash. And remember too that that is not the same thing as your emergency fund. Your emergency fund should not be anywhere near your stock portfolio. Your emergency fund stays in your checking account or in your savings account. It does not stay in your trading portfolio. So this is not your emergency fund. This is cash sitting on the sidelines ready for a potential opportunity. So one of the things I recommend is to take some profits off the table if you have good profits on certain stocks. And another thing you might want to do as well, it's always an option, is to take your investment out. So let's say, for example, you had invested in 100 shares of a company at $10 a share, and this was a $10,000 investment. And then let's say you had 100% return on that investment, you did really well, and so now that is 100 shares at $20 a share worth $20,000. Well, if you still want to have some skin in the game, but you also want to increase your cash pile, you always have the option of taking your investment out of it. So in this scenario, you could sell half of it, or 50 shares at $20 a share, and get that $10,000 back out of it, and then leave the other $10,000 in the market and let that money ride. So at that point, you're playing with house money, as I like to say, and so that's always an option you have as well, is to take your investment out and let your earnings or your profits ride at that point. But what I did, and this was completely unrelated to the market, but back in January, when I thought I was going to be buying a house, I had sold a lot of my stocks. I sold Amazon, I sold Google, I moved a lot out of the market and increased my cash pile. And then when that whole house situation fell through, I still have a lot of cash I have to return to the market, but I'm gonna be keeping a good pile of cash right now, at least probably 30 to 50% held in cash, just waiting for a good buying opportunity. And cash is king at the end of the day. That's the title of this lecture here, Cash is King. It's never a bad thing to have cash. Now, you don't want to have too much cash sitting around to the point where it's losing its buying power due to inflation, but it's always good to have some cash on the sidelines, especially if you're expecting there to be a bear market. So the other thing that you can do as well when it comes to investing and increasing your cash pile and related to bear market investing is to use a trailing stop order. So let's say you are invested in the market, you have a stock that you've made a decent return on, and you're gonna sell once it falls, but you don't want to sell right away. One thing you might wanna do is set up a trailing stop order. It's a type of market order, it's quite common. And basically what that does is you can set it so if you have a certain percentage drop intraday or in one trading day, it's gonna automatically sell that stock for you. So let's say, for example, you wanted to have a trailing stop order set at minus 7%. So if at any point in time during one trading day that stock falls more than 7%, you're automatically going to sell, and so that's what you're going to do. So for example, let's say on one trading day the stock climbs 10%, the next it falls 5. Well, it didn't fall 7 in that trading day, so it doesn't execute that sell order. Next day you climb 7, the day after that you climb 7, but then the 5th day it falls 10%. Well, as soon as that stock falls 7% in one day, it executes a sell order, and then you no longer own those shares because you sold them. But there is one thing you have to keep in mind when you're using this type of order, is that that stock could fall 6% on day 1, and 6% on day 2, 6% on day 3, and your order didn't execute because it's set at minus 7. So you could lose 18% over the course of 3 days and not have that order executed just because it didn't fall 7 in one trading day. So just be careful when you're using those trailing stop orders, just because there's always the potential for that stock to fall over a longer span of time than one trading day. And so you always want to monitor that as well, not just assuming this is going to be protecting you There's always that downside risk of worrying about that stock falling a little bit each day and not having such a massive movement in one trading day. But anyways, that wraps up the first lesson here talking about bear market investing. Holding cash is a great idea. As far as the percentage goes, that comes down to your investing strategy. Like I said, I'm probably going to be aiming for 30 to 50% cash right now. And this just comes from me taking profits off the table. Once I say, okay, this company is becoming overvalued, or okay, I'm happy with this return, I'm going to take some profits, or maybe I'm recognizing long-term capital gains, or whatever the situation is. It's good to have cash. Cash is king. And the other thing you might want to do is consider, taking your money out of it and letting the profits ride and playing on house money, or possibly using a trailing stop order. In this video, we're going to be covering the second topic, which is very simple. It's called dollar cost averaging. This is one of my favorite strategies when it comes to investing, whether or not you're in a bull market or a bear market, because it keeps you out of trouble. It keeps you out of buying at the top of the market and buying in when stocks are overvalued. And what happens is, over a long stretch of time, you're paying the market average for ownership of this stock. So what you're going to find in bull markets, stocks become overvalued, and then in bear markets, stocks become undervalued, and somewhere in between you find a fair valuation of what you should expect to pay for that stock. And so what happens when you dollar cost average is you're buying shares over a long span of time, and so as a result you are paying the market average price for those shares. So what you're doing here is investing the same dollar amount every single month. And this all comes down to what you can reasonably afford. Maybe for somebody it's $100 a month, maybe it's $500. For me, I usually try to put anywhere from $1,000 to $3,000 a month of new money into the market every single month, but it all depends on where you're at financially and how much money you can funnel into the market. But what you're doing here is you're slowly accumulating shares over a long span of time, and over time you're going to be paying the market average for those shares. Now what happens normally is people get excited during a bull market and they say, okay, I'm going to funnel more money into the market. They're seeing a return. But as soon as they see a bear market, they stop putting money into the market. They become fearful. They say, oh, I'm losing money in the stock market. I better not put any money into it. And that is when you run into trouble, because you're going to want to be continuing to funnel money into the market in order to be lowering your cost basis or smoothing that number and paying that average price. So make sure that, if anything, you're putting more money into the market during a bear market and less during a bull market. When it comes to investing, the right thing to do often feels like it's wrong emotionally because it's a little scary, but during a bear market, that's the time when you want to be funneling more and more money into the market. So what you're doing is slowly accumulating shares over a long span of time, and as a result, paying the market average price per share. So I drew a chart here just to explain this, but I'm sure you guys can visualize it. It's a pretty simple concept. You're buying shares at a certain price. You're buying them lower. You're buying them lower. So this would be your bear market. And then that turns into a bull market, and you're buying at the same time every single month, or maybe you're doing it weekly, and you're buying the same amount as it's going down and the same amount as it's going up. And as a result, you're paying pretty much this market average over that long span of time. So just to use an example here, numbers-wise, let's say you were looking at a stock and you started buying shares at $7 a share. So you bought 10 shares at $7, 10 shares at $6, 10 shares at $5, 10 at $4, 10 at $3. Well, your cost basis on those shares is actually $5 a share. So despite the fact that that stock you started buying at $7 and $6 a share, your average price paid per share is actually $5. So you own 50 shares at $5 a share. And so that's what you're doing by dollar cost averaging, is you're buying shares over a long span of time. You're accumulating them slowly, and as a result, you are smoothing out the price you're paying, and you're making sure you're not buying at the top of the market. So anybody who is just now starting to get into the stock market, I would do no lump sum investing at the top of the market, at the top of a bull market. You're just asking for trouble. Instead, follow a dollar cost averaging type strategy, and this works with stocks. This works with ETFs. One of my favorite ways to dollar cost average is into dividend stocks. I will buy into dividend stocks, I'll dollar cost average, and then I'll also set that up with a drip so my dividends are reinvested. And we're going to talk about this later on, but one of my favorite things to do during a bear market is to go hunting for dividends and invest in dividend stocks. But dollar cost averaging is a great strategy for dividend investing because you're making sure you're paying the market average or the fair price for those shares, and you're also reinvesting those dividends with a drip. So my number one strategy when it comes to bear markets is dollar cost averaging. I hope you guys can see why that is. And that is my favorite strategy to follow and the one I recommend to beginners, especially if you're just now getting into the market, dollar cost average. Anyways, in this video, we're gonna move on and talk about my third bear market investing strategy, which is very simple. I'm gonna call it dividends, baby. It's to go hunting for dividends. One of the easiest things you can do during a bear market is look for stocks that have a strong dividend history. They have been paying dividends for a long time and rising those dividends, and look for high dividend yield stocks. Now, you're not going to go out there and sort by the highest dividend yield and start buying stocks with a 20% dividend, just because if you took my course here on Fundamental Stock Analysis 101, you know that high dividends are often a trap. But what you can do is you can calculate that dividend coverage ratio to make sure this company can actually afford to pay that dividend. And if this is a company with a high dividend that has the ability to pay that dividend based on the coverage ratio, and they've been growing dividends for a long time and they have a long history of paying dividends, that would be a great time to pick up shares of that stock and take advantage of that dividend. Now, I'm going to cover this just in case you guys didn't watch that course there, but it's part of this as well, Fundamental Stock Analysis 101. But to calculate the dividend coverage ratio, all you're going to do is take the annual earnings per share, and the best way to do this is to use the 12 trailing months of data, and then divide out the annual dividends paid per share. And that essentially tells you how much the company is passing along to shareholders in dividends relative to their earnings. So what number are you looking for? So below 1 is bad. That means that the company is actually paying more in dividends than they're actually earning. And as we know, dividends are not guaranteed and they can be cut really at any point in time. And so if you're investing in a company that's paying a higher dividend than they can even afford, they're paying more in dividends than they're earning, then there is a strong potential for a dividend cut. Now, 1 to 1.5, I'm calling that meh. It's not very good either, because that means that company is paying a lot in dividends and they're likely going to be restructuring that in the future, whether that means a cut or they are going to be canceling that dividend altogether. So what I'm looking for is a dividend coverage ratio of a 1.5 to 3, and that's going to be a good, healthy dividend coverage ratio, and that means that company can afford to pay that dividend. Now, on the other side of the coin here, when that dividend coverage ratio climbs above 3, and it's a 3+, that means that company might actually be greedy and they are retaining too much of their earnings for themselves and not passing along the dividends or the earnings to shareholders in the form of dividends. So you want to look for a happy medium there of a 1.5 to 3, and that generally means that company can afford to pay that dividend. Now, what else can you look for as far as dividends? Like we said, you want to look at the dividend history as well as the growth streak. And there's no real resource to find this. You kind of just have to research it on your own or look at the dividend history and see if they've ever had a period of time where the dividend was flat or decreased. Because the thing is, companies are going to want to increase their dividends. They want to have a strong growth streak because that's going to attract investors. So most companies, at all costs, the worst thing they can do is cut their dividend, and they're only going to do it if it's absolutely necessary, because they know as soon as they cut that dividend, the share price is going to fall as a result. So they want to keep shareholders happy, they want to keep that dividend growth streak up, and so a dividend of a company that has been paying dividends for decades and they have a decade-long growth streak, that's a pretty safe dividend. They're only going to cut those if it's an absolute necessity. And one example of this is Pfizer. That was a company that had to cut their dividend. I believe it was 2008 or 2009, but they had a very long growth streak, but because it was the depths of a recession, they absolutely had to cut that dividend. But most companies are going to try to cut everywhere else other than that dividend just because they don't want to piss off the shareholders. The other thing that you have to realize is that during a true bear market, in the depths of a bear market, it's possible to find a stock that's been battered and dragged down by the overall market with a 10% dividend yield that's actually a sound investment. And just the idea behind a 10% yield is crazy, because that means that if you bought that stock, and even if the stock did nothing, well, in 10 years you got your money back just in those dividends. And so it's not out of the realm of possibility to find a stock with a 10% dividend yield during a bear market. And so one of my favorite strategies when investing in a bear is to go out there and start hunting for these dividends and check the coverage ratio, check the dividend history, and make sure they have a history of paying this dividend, and then scoop up the shares of some dividend stocks out there of companies that you like, and then reinvest those dividends and accumulate some serious wealth in the process. So the best thing you should do here is obviously, like we said earlier, dollar cost average. That's one of the best strategies for a bear market, is accumulate shares over a long span of time. And also set up a DRIP, a dividend reinvestment plan or program. That way all of your dividends are being reinvested back into the issuing stock. And as I'm sure you guys know, that allows your dividends to earn more dividends, and in the process you earn that compound interest, and that is something that, again, will make you very wealthy just in and of itself. But the final thing I'm going to say here as far as dividends go is my old saying here. I don't know if I heard this from somewhere or if I came up with it, but don't be dazzled by dividends. So many people are dazzled by dividends. They go out there and they see a 20% dividend yield and they go, oh my gosh, I can get my money back in 5 years. This is amazing. But they don't realize that the reason that dividend yield is so high is because that stock has fallen massively in the short term, and likely a dividend cut is around the corner. So always start off by looking at the stock. Look at the actual company, check out the balance sheet, make sure they have sound operations, look at the dividend history, the growth streak, and the coverage ratio, and if all of that checks out, then it's probably a good stock to consider investing in for dividends, but don't solely rely on the dividend yield. And now we are moving on to part 4, and we're going to be talking about one of my other favorite investing strategies when it comes to bear markets, and that is just simply finding the value. It's all about applying those principles we learned in Fundamental Stock Analysis 101 and taking a deep dive with these companies, looking at the financial documents, looking at the balance sheet, and determining whether or not this is a financially stable or financially healthy company. And then look for a company that is trading at a price that is below the underlying value. That's all about what Benjamin Graham talks about, and Warren Buffett is, you're going to want to be greedy when others are fearful. And the thing about a bear market is there's widespread fear everywhere. People are afraid of stocks. They want to do anything they can to get them off their hands. And so as a result, that price starts to fall, and it gets to a point where that price is well below the underlying value of that ownership right of that company. So how do you find the value? Well, like I said, guys, go through Fundamental Stock Analysis 101 and you'll learn all about, the fundamentals of a company and what to look for. But these are a few of the things that I would look for if it was a bear market and I'm ready to invest in some good, durable companies that are being battered by the market. First of all, one of the most important things to look for is low debt load this company has. Look at both the short-term debt and the long-term debt and make sure this company is not burdened with debt. I always like investing in companies with a low debt load. A good example of this is Google or Facebook, companies without a lot of debt, because they have more of the ability to weather a storm. And I always compare the balance sheet of a company to like my own balance sheet. And I think about, if I was this company, if I had a lot of debt and I had to pay back that debt and all of a sudden I was making less money, I'd be kind of in a pinch. But if you look at a company with very low debt, and even if they are starting to see less revenue, well, they don't have as much debt, they're not paying as much interest on that debt, so they can actually weather that storm a little bit better. And so that's always what I think about. That is why I look for companies that have a low debt load. So that's what I look for. You can see that on the balance sheet, looking at the current assets, current liabilities, and also look at the liquidity ratios for a company. And then the other thing to consider here is the operating history. Are we looking at a blue chip stock that's been around for 100 plus years? Or are we looking at a stock that's been around for 5, 10 years? What are we looking at here? Because you have to realize that companies that have been through these storms before are going to have better success, and they're more durable and time tested. Look at a stock like 3M or General Mills. They've been through so many bear markets. They're going to be able to weather that storm better than a stock that's brand new. So you always want to think about that. And 3M and General Mills are actually more defensive investments. But even a stock like Apple that's been around for a long time, they've been through bear markets where they're going to see periods of less discretionary spending on their products, but they're able to weather that storm because they've been through it already. And so that's something I always consider as well. Is this a company that's been around for a long time, or is this a brand new company that has never been through a bear market before? And I always like to invest in those companies that have been through it before and they are time tested. But as far as looking for the debt load of a company, one of the best things you can do is just look at the current ratio. It's one of the liquidity ratios, and I would brush up on all those and become familiar with those. But the current ratio is very simple to calculate. You take the current assets on the balance sheet, divide it by the current liabilities, and that's going to give you an idea of the asset to liability ratio as far as short-term assets and short-term debt. And you want to find a company with a 1.5 or above. The higher that number is, the better off. But if the current ratio is below 1, that actually means that the company has more current liabilities than they do have current assets, and that would be something you are not looking to see. Anyways, past that, looking at the current ratio, looking at the liquidity ratios, what you can look for in a late bear market when it's going to start to hopefully emerge into a bull market, you're going to want to start looking for growth. And you can look for growth in two places. First of all, you can look for top line growth in terms of revenue growing, or second of all, you can look for bottom line growth in terms of earnings growing. But that's usually one of the first indicators that a company is going to be turning around, is when you start to see top line growth for that company. You start to see revenue numbers turning around and starting to increase. And then other things you can look for companies that are restructuring, look for companies that are having layoffs, look for companies that are having consolidation. Now you do have to be careful here, because you don't want to be investing in companies that are shutting down and really winding down their operations. But if you're looking at a company that's been around for a long time, a blue chip stock, and you hear about them having layoffs and cutting back and reducing their expenses and their operations, that's usually a good sign as far as that consolidation and restructuring goes. If you're looking at a brand new company and you hear that they're laying off 50% of their staff, that wouldn't be a good sign, obviously. But looking at a time-tested large company having some layoffs and some consolidation, I do see that as a good sign, but I know a lot of people would actually disagree with me on that one. But that is something that I look for, and it's actually something I saw going on with General Electric when I was looking at that stock. When you heard about them doing layoffs and kind of consolidating, I actually see that as a positive for a stock like that. Other than that, other fundamental indicators to look for a PEG below 1. That means that that stock is undervalued based on their anticipated growth potential. In general, looking for a low price to earnings or a low forward PE based on the industry. And then also take a look at that PB ratio, because if that stock is trading at a price to book below 1, that means that stock is trading below the actual book value for those shares. But the other final piece of advice I'm going to have for you, in a bear market, just keep it simple. Bear markets are not the time for complicated investing strategies. Really, there's never a time for that, in my opinion. But if there was ever a time to do it, it's not during a bear market. During a bear market, keep it simple. Look for durable companies, blue chip companies that are being battered by the market. Look for strong dividends and a strong dividend history. Analyze the fundamentals, find the value, and start scooping up shares of undervalued companies. And that's pretty much as simple as it gets, and don't be too complicated with your strategy. It's certainly not the time to be playing around with things you're not experienced with, just in my opinion. But of course, that is up to you, and it's going to be a learning experience if you're wrong about it, and if you're right, maybe it will pay off. And today we're going to be talking about the 5th bear market investing strategy. This is one that I don't actually do myself, but a lot of people do this, and this is a strategy known as short selling. Now, there's a number of different reasons why I am not somebody who short sells, and one of them we're going to discuss when I go over an example of what can happen when you're short selling and you're wrong about your particular bet. You can lose a massive amount of money when it comes to short selling. There are a number of different reasons why I personally do not recommend it, but I just wanted to expose this idea to you guys in case you are interested in doing more research on your own and learning more about this investing strategy. But just understand that I personally do not get involved with short selling, and I don't necessarily recommend it, especially for beginners. But if you're a seasoned investor and you know what you're doing and you have a massive amount of risk tolerance, then maybe short selling is something that makes sense to you. But anyways, in order to identify what short selling is, we have to start by talking about the opposite, which is what most of us are familiar with. It's the type of investing that I do, and it's called long investing. Long investing is very simply betting that a particular stock or asset is going to go up in value. So maybe you liked Microsoft stock, for example. If you were long on Microsoft, that would mean you're betting that stock is going to go up in value. So you make money by buying shares of that stock and then down the road selling them at a higher price. A short seller is looking to do the exact opposite. They're looking to make money when the stock goes down in value. And so when you're short selling, you're actually betting that the stock will go down in value. Now, this is a very complicated process here. A lot of people don't understand how this really works. How can you actually make money when a stock price falls? But essentially what you're doing is you're borrowing shares of that stock from your broker. You borrow shares, you're going to sell them to somebody else, and then down the road at some point in time, you have to buy back the same number of shares from the market and return those to your broker. And in that meantime there, while you are borrowing those shares, you're paying interest to your stockbroker. So it's a lot more confusing than a bullish investing strategy where you're just buying shares and selling them down the road. When you are short selling, there are a number of different factors involved, one of those being margin interest paid to your broker for the duration of time that you are borrowing those shares that you are short selling. Now, the other thing you have to know about short selling is that you can't do this in a traditional brokerage account, and most people out there are in what's called a cash account. I have a cash account, and that is what I use. With a cash account, all of your securities are paid in full at the time of purchasing or within 3 days when those funds are settled or the actual trade is settled. So your shares are paid for in full, and you are not borrowing money to pay for your shares. So if you're looking to buy 10 shares of Microsoft stock, you would need to have enough cash in your brokerage account to pay for those shares immediately. That's what you have to do with a cash account. On top of that, there is no borrowing of any kind. You are not borrowing money from your broker, and you're not borrowing shares like with a short sale. There's no short selling, there's no day trading. There are pattern day trader rules that you have to follow if you are doing any kind of short-term or swing trading. During a trading week, you have to be familiar with those or you can get in trouble. There are day trading requirements, pattern day trader rules. You have to have a certain amount of money or a certain amount of value in your account at all times. And so there's all that involved as well. But the most important part for me is that with traditional investing, in a cash account, your maximum loss potential is 100%. So worst case scenario, you invest in a stock and that company goes bankrupt and you never get any of that money back. That's the most you can lose, is 100% of your investment in a cash account. Now, on the other hand, let's talk about a margin account. A margin account is what you have if you are a day trader or if you are looking to short sell stocks. This is going to happen in a margin account because you have to borrow those shares from your broker, and there is no borrowing in a cash account. So with a margin account, essentially what happens here is your broker, if you are looking to buy stocks on margin, and margin is just giving you leverage, you're borrowing money to buy stocks, they will usually loan you $1 per $1 you have in your account or invested in other stocks. So if you have $10,000 in your brokerage account, your broker will lend you typically another $10,000 you can use to invest in stocks, and then you're investing with margin. And your idea is that by investing that $10,000 you're borrowing from your broker, you're going to be able to get a better return than you're paying in interest. Again, this is something I don't do myself, but some people want to have leverage and they want to have additional money to invest that they don't actually have. So they borrow it from their broker. Now, with a margin account, there is usually a credit check involved because they are loaning you money. They're going to be running your credit, whereas with a cash account, they just need to verify your identity. So it's a little bit more difficult to open a margin account. And margin interest is paid to your broker. Typically, this is paid monthly. Or there are services like Robinhood has Robinhood Gold, and you pay a dollar amount monthly fee to have a certain amount of buying power available to you. But you have to understand that with a margin account, your stocks in your account are your collateral for that debt. And so this is something called a margin call, where if you make a bet on a particular stock, if you're doing a short sale or if you're using margin, and all of a sudden you fall below that margin requirement, you're going to get a call from your broker or a notification saying, hey, you need to deposit more money into your account. Otherwise, we're going to sell some of your stocks for collateral because we don't believe you have the ability to pay us back for this loan that we gave you. And so that's something you have to watch out for in a margin account, is a margin call. And with a margin account, you have above a 100% loss with that investment. And so let me go ahead and go over an example of that for you now, just so this is easy to understand, of a short sale that goes wrong. So let's say you're looking to short 100 shares of a stock at $100 per share. So you borrow those shares from your broker, you sell them to somebody else for $100 a share, and so you have this short position at $100 per share, 100 shares. So it's a $10,000 short on this particular company. Now you're paying margin interest for a period of 6 months, and you're paying 6% interest. So in those 6 months, you pay $300 of margin interest to your broker. Now, down the road, you cover this position. You were wrong about your short sale, and you cover at $250 per share. So the stock was 100 a share, you thought it was going to go to 10, but instead it went to 250. It went completely in the wrong direction. You cover at $250 per share, which means you have to go buy 100 shares off the market at $250 for $25,000, okay? So how much did you actually lose on this short sale? Well, you lost $25,000 in the means of having to buy that off the street, buy that off the market to give that back to your broker, and you also lost $300 of the margin interest that you paid in that period of time. So on that investment there, on that $10,000 short sale, you lost $25,300. That is what is dangerous about short selling. That is something that a lot of people don't understand, is that you can lose a lot more than 100% of your investment. And so that right there is a big reason why I don't get involved with short selling, is that the losses are potentially infinite. But if you guys are interested in short selling, I'm definitely not going to be the one to educate you on this just because I've never done it myself and I never will be doing it. I'm also not somebody who gets involved with options, and I know a lot of people will use options for bear market investing strategies, but again, it's not something I do myself, so I don't educate people on things I'm not actually doing. But that is, again, something you might want to explore and learn more about yourself, but I'm definitely not an expert on it, and I just wanted to explain to you why I don't short sell. It's because of this reason right here. In this video, we're going to be talking about a financial instrument called an inverse ETF, and this is very similar to short selling, what we covered in the last lecture. And again, I just want to state this is not something I do on my own. I do not invest in inverse ETFs or leveraged ETFs. I just want to expose this to you just so you are aware that these financial instruments exist, and if you want to do further research on your part and invest in these, that is completely up to you, but understand that I am not investing in inverse ETFs and I don't recommend it. I am a bullish investor, and I believe there are opportunities to make money in a bullish manner in both bull markets and bear markets, and so I would much rather prefer to buy shares of an undervalued stock in a bear market or invest in dividend stocks than I would invest in something like an inverse ETF. They're very complicated financial instruments, and I don't have enough risk tolerance for this type of investment. It's just not for me. The amount of risk involved is just something that I'm not comfortable with. But anyways, I'm going to tell you guys a little bit more about them just so you can have a basic understanding of what inverse ETFs are. So inverse ETFs are a collection of derivatives, and a derivative is simply something that derives its value from something else entirely. It's a collection of derivatives with the goal of profiting from the decline in the value of an underlying benchmark. So to explain that very simply, it goes in the opposite direction of that benchmark in a 1-to-1 ratio if it's an inverse ETF with no leverage involved. So a couple of examples here. PSQ is an inverse ETF that does the exact opposite of the NASDAQ. So if the NASDAQ goes up 1%, this ETF is going to go down 1% or very close to 1%. It's not guaranteed, but they try to do this as closely as possible. DOG is the inverse of the Dow Jones Industrial Average. It's going to do the exact opposite within one trading day. And then SH is the inverse ETF for the S&P 500, and it's going to do the opposite of that. So if the S&P 500 goes up 2%, this will go down very close to 2% in that day. Now beyond that, we have something called a leveraged ETF. A leveraged ETF amplifies the returns of the underlying benchmark, typically in a 2-to-1 or 3-to-1 manner. It's very similar to margin, where you're borrowing money to increase your buying power, but you're not actually paying margin interest in this case with a leveraged ETF. But so basically a leveraged ETF is going to amplify the return of that underlying benchmark, whether it's a bullish ETF, a bull ETF, or an inverse ETF. Now an inverse leveraged ETF is going to amplify the profit or loss from the change in the underlying benchmark. And if you guys are getting confused by this, it just goes to show you this is a very complicated financial instrument. It is not for beginners. It's not something that I invest in myself. It's very complicated. But if this is something that's making sense to you, maybe you're going to explore this on your own. But just a couple of examples here. QID is a leveraged inverse ETF of the NASDAQ. So it's going to do the exact opposite of what the NASDAQ does in a 2-to-1 manner. So if the NASDAQ were to go down 1%, this fund would go up 2% or very close to 2%, and if the NASDAQ went up 2%, this fund would go down roughly 4%. So it does the exact opposite of what the NASDAQ does, but with a 2-to-1 ratio of leverage. DXD is the negative 2x of the Dow Jones Industrial Average, and SDS is the negative 2x of the S&P 500. Now beyond that, we have another type of inverse ETF or leveraged ETF available that is going to be sector specific, and these are going to be doing the same thing, but the underlying benchmark is an actual sector. So for example, SKF is going to do the exact opposite in a 2-to-1 manner of the Dow Jones US Financial Sector or Index. And then the SSG is going to do the exact opposite in a 2-to-1 manner of the Dow Jones US Semiconductors Index. So for example, let's say you were very, very bearish on the financial sector. You might say, I'm going to buy shares of SKF and I'm going to be having a leveraged bet against the Dow Jones Financials Index, and you're betting against these companies through derivatives. Now, this is the thing here. This is not as risky as short selling because potentially you can lose 100% of your money here if that ETF goes to zero. And understand that it's only in very rare circumstances that inverse ETF could go to zero. I spent a lot of time researching this. I could not find any examples of one that did, but there was a time when a couple of leveraged ETFs in both oil and natural gas were very close to going to zero. But for this to happen, it would have to have a massive intraday move in that underlying benchmark. So we would have to see oil or natural gas prices fall like 20 or 25% in one trading day for this ETF to go to zero. But it can happen. It is possible for a leveraged or inverse ETF to in fact go to zero. So it's something you have to keep in mind. But it's not as risky as short selling. But again, this is not something that I personally get involved with myself. I just wanted to let you guys know that these are out there, and you're going to want to do a lot more research on these before you start investing in them because they are very, very complicated.